I was 18 for 11 days before I found the letter. Not a birthday card. Not a "congratulations, you're an adult now" note. A collections letter, addressed to me, for a credit card I had never applied for, never signed for, never even seen. Balance, $4,200. Account opened when I was 14. My dad had opened it in my name because his own credit was too wrecked to open anything himself. He needed a new card to cover a shortfall one month, and I was 14, and I had a social security number, and apparently that was all that was required. He meant to pay it off. He always meant to pay it off. That's the sentence that describes most of my childhood, actually. He meant to. I'm not telling you this story because it's rare. I'm telling you because it's not. Somewhere between 1 and 2 million Americans discover they're a victim of identity theft involving a family member every single year. And the overwhelming majority of those cases are exactly this: a parent, a relative, someone who had access to a kid's social security number before that kid could vote, drive, or legally sign a lease. But here's what nobody prepares you for. The credit card is the visible problem. It's the one with a dollar amount attached, the one that shows up on paper, the one you can point to. The invisible problem is bigger. It's the fact that you turned 18 with zero instruction on how any of this works, inside a household where money was a source of dread instead of a subject anyone explained to you. And now you're expected to build an entire financial life from a foundation that was never poured in the first place. This is what that actually looks like. Not the motivational poster version, the real one. And by the end, I'm going to show you exactly how someone in this position, no credit, hidden debt, no financial plan, no one to ask, turns it around. Because it happens. It happened for people who had a much worse starting point than you probably think is possible. Let's get into it. Let's start with what inheriting your parents' financial mistakes actually means, because it's not one thing. It's usually 3 separate problems stacked on top of each other, and most 18-year-olds don't even realize they're dealing with 3 problems. They just feel one big fog of dread and assume that's normal. Problem 1 is debt that's literally in your name. This is the identity theft version, like mine, but it's also the more common and less dramatic version, the phone plan your mom put you on the family account for and never separated. The "just co-sign this car loan real quick, I'll make every payment" arrangement that teenagers get talked into constantly. A co-signed loan doesn't care whose idea it was. If the primary borrower misses a payment, it hits your credit file exactly as hard as if you'd missed it yourself. About 38% of co-signers end up making at least one payment themselves because the primary borrower couldn't. That's not a rare edge case. That's more than 1 in 3. Problem 2 is debt that's not in your name, but is absolutely going to become your problem anyway. The kind that shows up as a phone call asking to help out this month, or a family credit card that suddenly needs your income to keep making minimum payments, or a household where the electric bill sometimes doesn't get paid and everyone just quietly adjusts. You don't owe this money legally. You owe it emotionally, which turns out to be almost as binding, and financially it drains you at the exact moment you need every dollar to build your own foundation instead of patching someone else's. Problem 3 is the one nobody puts a dollar figure on, and it's the one that does the most long-term damage. You were never taught the operating system. Only a minority of states currently require students to take a standalone personal finance course to graduate high school. And even in the states that do, the class often gets treated like a formality, a semester of worksheets nobody remembers 18 months later. So you didn't just inherit debt. You inherited a knowledge gap in exactly the subject you now need to master under pressure, on a deadline, with real consequences, while everyone around you assumes you already know this stuff because you're an adult now. That's the actual inheritance, not one crisis. A financial identity built by someone else, a debt structure you didn't design, and a total absence of instruction on how to build something different. And I want to be honest with you about something before we go further. This is genuinely harder than starting from zero. Starting from zero means you have a blank page. You're starting with a page someone else already wrote on, in pen, and you have to write your own story in the margins while also, eventually, erasing theirs. Let's talk about credit specifically, because this is where most 18-year-olds in this situation get the most confused, and the confusion costs real money. If your name is already attached to accounts you didn't create or didn't manage, an authorized user card that ran up a balance, a phone bill sent to collections, a co-signed loan with missed payments. Your credit file might already exist before you've ever applied for anything yourself. That's disorienting. Most 18-year-olds imagine credit as a blank slate they get to build from scratch. If you're in this situation, you might be checking your credit report for the first time and discovering you're not starting from zero. You're starting from negative. Here's the first move, and it costs nothing. Pull your credit reports from all 3 bureaus. You're entitled to free weekly access through annualcreditreport.com. That's the one legitimate free source, not the ads you see for free credit score apps that are actually selling you something. Read every account listed. If something is there that you didn't open and didn't authorize, that's identity theft, and it has a specific legal remedy. You can file an identity theft report with the FTC, place a fraud alert or a full credit freeze on your file, and dispute the account directly with the bureau. Minors' social security numbers get used this way constantly, precisely because nobody checks a 14-year-old's credit report. The fraud can sit there for years, quietly aging, before anyone notices. If the debt is real, meaning you did co-sign it, or you were a knowing authorized user, or it's simply your name on something that's now delinquent, the moves are different, but just as concrete. You call the lender. Not your parent, the lender. You ask what your options are. Can the loan be refinanced to remove your name? Is there a hardship program? What's the actual payoff balance versus what's showing as owed? Lenders would generally rather work out a plan than lose the account to default, because default costs them money too. Most people never ask this question because asking feels like admitting failure. It's not. It's the single highest leverage phone call available to you. And here's something worth sitting with for a second. A FICO score isn't a moral judgment. It's a math problem with 5 inputs: payment history, amounts owed, length of credit history, new credit, and credit mix, weighted in that order of importance. Payment history alone accounts for roughly 35% of the score. That means the single fastest way to start repairing a damaged file, once you've sorted out what's fraud and what's real, is simply not missing another payment on anything starting today. Not a big balance, not a perfect score, just an unbroken news streak starting now that begins overriding the old pattern with a new one. Credit scoring models generally weight recent behavior more heavily than old behavior. The past matters less than what you do next. That's not a slogan. That's literally how the algorithm is built. Now let's talk about the part that's harder to fix with a phone call: the absence of a plan. Money experts talk about a financial operating system, the invisible set of rules a person runs on. Do you check your balance before you spend or after? Do you know the difference between a debit card and a credit card at a mechanical level or just a vibes level? Do you know what APR actually means, not just as a word you've heard? If you grew up in a house where money was either a source of screaming fights or a topic nobody discussed at all, you likely absorbed one of 2 operating systems. Either money is scarce and terrifying and every purchase is a crisis, or money problems get solved by not looking at them. Both are catastrophic starting points, and neither one is your fault, and both are completely fixable. Because an operating system is just a set of habits, and habits can be rebuilt at any age. Here's the first rule of the new operating system, and it's less exciting than anything you'll find on a finance influencer's page. You need a number. Not a goal, not a dream. A number. How much money is actually coming in each month, and how much is actually going out? Around 74% of Gen Z reports feeling anxious about their finances, and a huge percentage of that anxiety isn't caused by not having enough money. It's caused by not knowing. Uncertainty is scarier than a small number. A known $340 in your checking account is less frightening than an unknown amount you're afraid to check. Look at the number. Write it down. That single act, just looking, moves you from a passenger to a driver, even if the car itself hasn't changed yet. The second rule: separate what's actually yours from what you've been carrying for someone else. This is an emotional exercise disguised as a financial one, and it's often the hardest step in the entire process. If you've spent your entire adolescence being the responsible one in a household where the adults weren't, You've probably absorbed a belief that taking care of everyone else's money problems is simply what you do. That belief will bankrupt you slower than any single bad decision ever could, because it doesn't cost you once. It costs you every month, indefinitely, for the rest of your life, unless you name it and interrupt it. You can love your family and still refuse to be their emergency fund. Those two things are not in conflict. They only feel like they are because nobody ever modeled the alternative for you. Let's build the actual plan now, because a video that just describes the problem and stops there isn't useful to you. You need something to do on Monday morning. Step 1. Open your own accounts, completely separate from any family account, at a bank or credit union that isn't shared with anyone else. This sounds obvious. For a lot of people in this exact situation, it's the first time in their life that a dollar exists somewhere nobody else can access, move, or borrow real quick. That separation is not selfish. It's the foundation everything else gets built on. You cannot build a house on land someone else owns. Step 2. If your credit file has real, legitimate debt on it, the co-signed loan, the account you knowingly used, get it into a specific, written plan, not a vague intention. List every account, the balance, the interest rate, and the minimum payment. Most people who feel overwhelmed by debt aren't actually overwhelmed by the amount. They're overwhelmed by the fog around the amount. A spreadsheet with 5 rows on it turns an abstract anxiety into a solvable math problem. And math problems, unlike feelings, have endpoints. Step 3. Build what's usually called a starter emergency fund. Not the full 6 months of expenses version you'll hear about eventually. Just $500 to $1,000, sitting untouched in the separate account from step 1. Here's why this specific, seemingly small number matters so much for someone in your position specifically. The entire reason your household's debt exists in the first place is very often a single sentence. Something broke, and there was no cushion, so it went on a card. A $500 cushion breaks that exact chain reaction before it starts. It's not enough to solve a real emergency. It's enough to solve the $180 car repair or the $90 doctor's copay that would otherwise become the first domino. Step 4. If you're working, even part-time, open a Roth IRA and put something into it. Anything, even $25 a month. I know this sounds premature when you're also thinking about debt, but here's the actual math on why it's not. Money invested at 18 has roughly 50 years to compound before typical retirement age, compared to money invested at 30, which only gets 40 years. At a historical average return around 7% after inflation, that 10-year head start alone can end up worth more than a decade of much larger contributions made later. You are not too young or too broke for this to matter. You are, in fact, standing at the exact moment in your entire financial life when a small amount of money has the most time to grow. Nobody tells 18-year-olds this because 18-year-olds rarely have anyone in their life explaining compound interest instead of explaining rent. Step 5. And this is the one people skip because it doesn't feel like real financial advice. Find one person outside your family who is good with money and will actually talk to you about it. A financial literacy nonprofit, a free counseling session through the National Foundation for Credit Counseling, a professor, a manager, an older coworker, someone who didn't grow up in your house and doesn't have the same blind spots baked in. You are trying to learn a language your household never spoke fluently. You cannot learn a new language only from people who don't speak it either. I want to walk you through 2 versions of the next 10 years, because this is where the story either becomes a warning or becomes proof, and I want you to see both roads clearly before you pick one. Version 1. Nothing changes. The debt in your name stays unaddressed because dealing with it feels shameful, and shame makes people avoid the exact paperwork that would fix things. The family financial patterns repeat because nobody interrupted them, and by 25, you're the one occasionally covering a parent's shortfall the way your parent once covered theirs. Except now you're the adult in the story, and the excuse of, "I didn't know better," no longer applies. Your credit score stays suppressed into your late 20s because you never disputed the fraudulent account, so every apartment application comes with a higher deposit, every car loan comes with a worse rate, every financial decision costs slightly more than it needed to, compounding quietly in the background of an otherwise normal-looking life. This version isn't dramatic. That's what makes it dangerous. It doesn't look like collapse. It looks like a life where money is always slightly tighter than it should be, for reasons that trace back to a 14-year-old's credit report nobody ever cleaned up. Version 2. You do the 5 steps. Not perfectly, nobody does this perfectly, and perfect was never the requirement, but consistently. You dispute the fraud in month 1. You separate your accounts in month 1. You build the $500 cushion by month 4. You start the $25 a month Roth IRA in month 6, once the cushion exists. By year 2, your credit score, freed from the old fraudulent balance and fed by an unbroken streak of on-time payments on whatever real accounts remain, has recovered into a range that gets you approved for normal things at normal rates. By year 5, the emergency fund has grown past the starter amount into something closer to real security, and the retirement account, still tiny by dollar amount, has quietly been compounding for 5 straight years, a habit now, not a decision you have to remake every month. By year 10, you are 28 years old, financially unrecognizable from the 18-year-old who opened a collections letter with shaking hands. And this is the part that actually matters most. You are now the person in your family who understands money, which means the pattern that started with your parents ends with you. Not because you were luckier, because you were the first person in the chain who had the information and used it. Same starting point, same inherited mess, completely different decade, built entirely from 5 unglamorous, boring, repeatable actions that nobody puts in a highlight reel because they don't look like anything while you're doing them. Here's the thing I actually want you to take away from this, more than any individual step. The debt you inherited was never a reflection of your character. It was a reflection of a system your parents were operating inside of. One where money wasn't taught, wasn't discussed, wasn't planned for, and eventually broke under pressure the way any structure breaks when nobody maintains it. You didn't design that system. You were born into it. But you get to be the one who redesigns it. And the redesign doesn't require a windfall, a rich relative, or a lucky break. It requires a credit report you actually read, a bank account nobody else can touch, $500 you don't spend, and one honest phone call you've been avoiding. I opened that collections letter 11 days after my 18th birthday, and felt like the ground had opened up under me. It hadn't. It just felt that way because I'd never learned there was solid ground underneath it the whole time. I just had to build it myself, one boring, deliberate decision at a time. You can too. Start with the credit report. That's this weekend's homework. Everything else on this list comes after. This isn't financial advice specific to your situation. Talk to a credit counselor or a financial advisor about your exact numbers. But the framework holds regardless of the dollar amounts. Name what's fraud, name what's real. Separate your accounts, build the small cushion, and find one person who actually knows this stuff to walk with you through it. You didn't choose the hand you were dealt at 18. You get to choose every hand after that.